Please welcome Pablo Hernández de Cos, Governor, Bank of Spain, and Bloomberg's Maria Tadeo.
This session I'm particularly excited about because I am Spanish too, and we're joined by the governor of the Bank of Spain, who we've known him for a long time now. Pablo, good morning. Thank you for being with us. Obviously, he's the governor of Bank of Spain. He took on that job in 2018. Before that, he was a chief economist at the Bank of Spain. Obviously, he knows the House very well, and by extension, the European Central Bank. And he's also chair of the Basel Committee, which is very fitting because we've talked about the banks and how that feeds into monetary policy. So to start off with an easy question for you, the European Central Bank has said that there is no trade-off between financial stability and price stability, the 2% goal. Does that mean that when you meet next week, well, in 2 weeks down in May, you're going to hike rates again?
As usual, Maria, you don't lose time. No? You go directly to the important question. No, thank you very much, Maria, and thank you to Bloomberg for the invitation. So let me try to summarize where we are in terms of monetary policy and also in this connection with financial stability concerns, that you were emphasizing in your question, Maria. Perhaps it's important to understand the context on which we had our last meeting, the meeting that we had in Frankfurt in March. You may remember that this took place in the context of the financial tensions related to the banking sector in Switzerland and also in the US. And we knew that at that time these tensions had already increased investor risk aversion. Also, they have created significant financial market volatility, and they had also led to a drop in bank share prices. So I think it was natural for us to try to emphasize as a key message, I would say even that the main message from our meeting is that we wanted to send this message that we still are closely monitoring the financial tensions created by these events, and of course that we stand ready to respond as and when necessary to maintain price and financial stability. And I guess that you shouldn't be surprised by this, because I always like to emphasize the content of our monetary policy strategy review, the one that was approved by the Governing Council of the ECB in July 2021, on which we emphasize is in the text that you can find in the webpage of the European Central Bank, that financial stability should be seen as a prerequisite for price stability. So that is a very important point to be taken into account. So then, more related to your question, Maria, what about future monetary policy actions? What can be expected from us for our May meeting? Again, something that we need to stress is that the financial tensions that I just referred to, that broke out before our meeting in March, imply an additional element of uncertainty around the scenario, the growth and inflation scenario that was prepared by the staff, and these projections were prepared before these tensions took place. So this extra uncertainty made us to stress even more the data-dependent approach that we've been following since almost the start of our tightening cycle back in December 2021. This basically means that our monetary policy will depend on how the numerous and the different sources of risk, including, of course, those related to financial market developments in the last weeks, materialize. So, in other words, this is something that I think even Philip Lane, our chief economist, was stressing this morning. Mm-hmm. If, and this is a conditional statement, if the baseline scenario in the March projections is confirmed, we will still have ground to cover to make sure that inflation pressures are stamped out. And in this regard, as you perfectly know, these projections are subject, as I was saying, to various sources of uncertainty, and this is why we are emphasizing this, that the rate path is data dependent, and this means basically that we are neither committed to raise further nor that we are finished with hiking rates. And in particular, the projections, again, were produced before the banking turmoil. It's true that so far the implications of this turmoil have been relatively contained. However, should they persist, or of course, if they aggravate, those tensions could lead to a sharper than expected tightening of credit conditions, and they could, of course, also erode confidence, and in the end, they could give rise to a scenario of more moderate economic growth and more rapidly declining inflation. So all in all, basically what we have to do in our May meeting is to analyze all the data in terms of the implications for the inflation outlook, the developments of underlying inflation, the strengthening and the strength of our monetary policy transmission, and then decide what the best is to do.
Right, and just to set the scene, because this is crucial not just for your country, but it's crucial to any country that has the euro. And we've seen that this year there has been very aggressive tightening from the European Central Bank. It's the fastest on record. The question for a lot of people is whether you get to this May meeting and you hike 25 basis points or essentially 50 basis points. What I understand from you, and again, this is very significant for every euro economy, and the banks too, and just the everyday lives of people that obviously make projections based on interest rates. What you're saying is that the data that will come up in the next 2 weeks, that will be key for how much you hike. So if I understand it correctly, you yourself, you don't have an idea yet in your mind as to how much you think is appropriate. Until you see that data in the next 2 weeks, that's both GDP and inflation, you haven't made up your mind.
So it's not so much about only exclusively to the information that is going to be published in the next 2 weeks. It is also that we have to take into account all the information that have been released since the cutoff date of the projections. The cutoff date of the projections, of the staff projections in March, was the end of February. So we have already accumulated a good number of surveys, even of hard data. Inflation, even today, was all the segregated information for the euro area was published. New information is still as pending, as you said, Maria. So we have to analyze this in a coherent way, compare all this information with the macro projections that were published in March, and then see to what extent the baseline scenario, including the assumptions on interest rates that were behind that baseline scenario, still prevail, and therefore decide what to do in terms of rates. And till now, I think the only relevant thing to mention and to stress is this sentence that if the baseline scenario, the one in March, prevails in May, this means that further hike will be needed. And then how many hikes, the magnitude of these hikes will depend on this assessment.
And can I ask you, I know maybe you're not going to give me a decision, and you've said you haven't made up your mind, so obviously you're not going to reveal what you're going to do in 2 weeks' time. But if you see some stress in these surveys to hike again interest rates by half a point, so 50 basis points, is there a danger that maybe you're doing too much in a time of uncertainty? Excuse me.
Well,
is that too aggressive?
This is exactly what we have to do. I mean, this is a risk for sure. There is also the opposite risk, no? That I mean, there is always for the central bank, there is always the risk to be too strong or the opposite, no? And of course, what we want to be is accurate and to be exactly in the middle. And I would try still to pursue that objective.
And how do you see the inflation perspectives? Because by now, I mean, it's obvious that it's way above the target of the European Central Bank. Your entire reputation as a central bank is being able to hit the 2%. If you're not able to do that, well, the question of your reputation and your ability to do it gets into question. That's terrible for a central bank. People see it in their everyday lives. The prices have continued to go up. Core inflation now seems sticky. Where do you see things going when it comes to inflation? Again, there's two measures here. The headline without the volatile components and then the core one. Do you fear separation, by the way, between the two of them? Because that would make it even more difficult for you.
No. This is a very important point, Maria. I think I see both of them as complementary, not as a substitute. No, so it is clear we've already emphasized that our future decisions will depend on our assessment of the inflation outlook, and this assessment will be informed primarily by our staff macroeconomic projections, on which all this new data I was referring before will be incorporated in a coherent manner. But of course, as we said also in our last meeting, a second input, and it's another input, an additional input, will be derived from the assessment of the dynamics of underlying inflation, and this will serve as a complementary cross-check of our forecast. So let me try to put you one example of an illustration of how I see things right now. No? So our baseline scenario, for example, of macro projections in March is one on which we are projecting gradual convergence of inflation to our 2% target. Okay, and there are a good number of reasons why this is the case. This downward trend is underpinned by the gradual disappearance of outward pressures from the reopening of the economy, from previous supply shocks, from the euro area. The depreciation, this will also be reinforced by increasing pass-through of the recent fall in energy prices, and also the exchange rate appreciation that has happened in the last months. The fall, of course, in inflation in the medium term will also incorporate the moderation in domestic demand pressures, which reflect, of course, also the effects of our monetary policy decisions, including on the euro exchange rate. In parallel, it's true that we have this central scenario on which we see this downward trend on headline inflation, but the reality is that in parallel we have seen that underlying inflation pressure, at least if you measure the underlying inflation pressures with core inflation, the one that excludes energy and food prices, but has remained on the rise and has kept us surprising on the upside. No? And the number today, 5.7% in March 2023, is of course a good example of this. So how I see things, no? Well, when you analyze core inflation, it's very important also to enter into the details on the disaggregated data that is behind core inflation. And there are like two main forces. No? On the one hand, first driver of core inflation are the indirect effects from past commodity price increases, which have been much larger than expected. And given the lags that we estimate for this pass-through to happen, we still see this effect as significant in 2023. But of course, on the other hand, at some point, the fall in energy prices, the improvement in supply chains, the demand that is, of course, moderating due to tighter financial conditions should begin to gradually produce reverse effects on inflation. No? So I like to say that we are in a kind of or in a sort of a crossroad, no? Where the lag effects of the past increases in commodity prices and exchange rate depreciation are still present, but diminishing, while the first effects of the most recent decreases and appreciation may be emerging and on the rise. No? And of course, one of the big questions, and of course this we need to monitor, is to what extent this second effect will be symmetric, no? As compared to the one that we've been observing that has led core inflation to the upside. These are some elements that we will have to monitor and analyze. Of course, then of course is the possibility, the probability of second round effects in terms of wages and markups is absolutely crucial. What's happening with the anchoring of inflation expectations there, the information that have been released in the last week have been good in terms of, for example, of the survey of inflation expectations by consumer, the one that is published by the ECB, and of course also fiscal policy will be very important. No? We know that fiscal policy has played a very important role in diminishing inflation in the last quarters, but at the same time we also know that when these fiscal measures will be withdrawn, they will create and provoke and cause the opposite effect on inflation. Of course, there is a lot of uncertainty on the magnitude and also on the timing of this effect. So this is why it's so important to be data dependent. So we have to look not only to both indicators, headline and core, but also to the factors, no, that are behind both indicators in order to understand what's going on and try to predict how inflation will be projected in the medium run.
And you mentioned the data. I wonder also, again, looking at this from the perspective of the central bank, but also your role as a chair of the Basel Committee, is there anything that makes you worry when it comes to the European banks. I mean, you referred to the turbulence that we saw in the financial sector, but this was a Swiss bank. The other one was an American bank. They were not really European regulated banks. But have you seen anything that makes you feel this chapter is not over yet? And we saw that panic in markets can move very fast.
Yes, well, no, let me, this is a very important question, Maria, and let me stress a few points. No? Points that, of course, will not be new for anybody in the room, but I think it's important that we stress them once and again. No? So the assessment that we have at the European Central Bank, at the Bank of Spain, the Eurosystem level, is that the EU banking sector is strong in both capital and liquidity terms. No? And the fact is that capital is much higher than it was 15 years ago. The liquidity position also of the European banks is robust. If you look, for example, at the LCR ratio, it is at the end of last year was above 160%, meaning clearly above the minimum requirements. It was even above the pre-pandemic levels, with a large part of these liquidity buffers in cash and deposits with the central banks. Very important, you were also mentioning it explicitly, Maria, this has been the result of the regulatory reform agreed internationally over the last decade. That, as you were stressing, in the case of Europe, these reforms have been applied to all banks, irrespective of their size. No? So this is the first point I wanted to state. Second point that I think is also very relevant is the fact that given the business model of our banks, the one that is prevalent in the Eurosystem, in the European Union, the fact is that so far our banks have been benefiting from the ongoing tightening of our monetary policy. And this is basically because the interest rate pass-through on the asset side still has been significantly exceeding the pass-through on the liability side. And the reality is that as a result, aggregate banking sector profitability has increased to its highest level. 2022 was at its highest level since 2014. But let me also emphasize a third point that I think is important, no? The role, in this case, of banking supervision. Even before the recent developments, recent events, certain supervisory priorities had been set within the SSM, the single supervisory mechanism, specifically to try to mitigate and anticipate the adverse effects of the current macro environment. And in particular, the supervisory focus was placed on banks' interest rate risk and also in the sustainability of their funding plans. So therefore, I mean, in some cases they were even some banks were asked to be more conservative in their interest rate assumptions. They were asked to even modify their model calibration and also validation. So these are all, of course, these three elements are very important. They are very positive. We have to take them into account. At the same time, as usual, I also want to be realistic and to be prudent. The reality is that, of course, there are several factors that will continue to weigh on the outlook for banks. The deceleration in growth is one of them. Combined also with higher interest rates in the end, will create also adverse impact on asset quality and also on lending volumes. They will also increase the funding cost of banks, with potential pressure, of course, also on interest margins. And very important, the impact of these factors is expected to become more pronounced over time. Okay, so the first effect of the interest rate hikes for our banks is positive, but once these interest rate hikes will lead to lower demand and also higher cost of funding of banks, of course, the impact will be less positive. And this is why, in the particular case of the Spanish bank, but I think we can also generalize to the Euro area banking system or to the European Union banking system, we are asking our banks to be very prudent in terms of provisioning or in terms also of capital planning, with the idea to preserve or even increase the current levels of resilience. And this is, this combination of, yes, stressing some positive elements that differentiate our banking system as compared to those that have been suffering the turmoils of the recent weeks. But at the same time, we stress that there are several factors that continue to weigh on the outlook for our banks. I think is probably the balance way to see things at this.
And sir, just a final question, because we're running out of time, but I have to ask you this question. Obviously, at the European Central Bank, every decision has to get taken by the inputs of every central bank. Sometimes as a majority, not fully consensus, not fully unanimous. We have seen that in the past meetings, there has been large majorities, but not consensus. Do you expect that this is going to be the dynamic going forward as decisions become more difficult? That yes, you get to majorities, but not consensus full-on decisions? Or actually you can get a consensus in the main decision where everyone agrees on whatever you do?
I think, I mean, of course, I cannot anticipate what my colleagues will think and will say and will vote for, no. But I tend to think that it is my experience of the last 5 years. That in very difficult moments, we've always reached a very broad consensus. No, my anticipation, my expectation would be for this to last in the following quarters.
Well, we'll find out soon enough. Well, sir, thank you so much for joining us here today. Well, we were hoping to see you in person, but maybe next time we'll manage to make it through. I know you're having very busy, so we appreciate your time and obviously all your inputs today. And we see you very soon in Frankfurt. Thank you very much.
Thank you, Maria.